We're on a roll, Itai, and you're the star of the show.
Awesome. Can everybody see my screen at the moment?
I can. Can I get a thumbs up from everybody who can see it? Oh, Zach, he's giving me a thumbs down. I saw somebody give a thumbs down, Alex. Okay, much better. Thank you.
All right, guys. So welcome to Equi University again, October 4th, 2021. As Jeremy mentioned earlier, we are Equi, your digital family office, the future of alternative investing. So let's get into the call because there's a lot to cover today. There's a lot of good information that we collected, and I just wanted to share it all. So let's start with the macro update. This is actually one of my favorite trading quotes of all time, and I'll show you what it relates to today. Markets can remain irrational longer than you can remain solvent. Famously said by John Maynard Keynes after the Versailles Treaty of 1919, where he was there and he realized that what the reparations that Germany has to pay for World War I could never be paid, and therefore they're going to have to print a lot of money in order to pay for that. He was actually in the conference. So he goes out and basically shorts the Deutschmark, thinking that inevitable collapse in the currency is going to happen. And of course, it did happen, as we all know. There was a very famous hyperinflationary period in the 20s, but it didn't happen when he thought it's going to happen. It took another 2 to 3 years, and the Deutschmark actually went up, and he basically lost all his money to later watch the whole thing collapse. So very famous words where the markets doesn't necessarily take their time potentially to do what they're supposed to do. Having said that, this is what's going on in the markets today. There's an unprecedented energy crisis in Europe, and it's been led by natural gas prices. So what you're seeing here in the red chart is the natural gas prices in the Netherlands versus in green, the natural gas prices in the US. There's been a very famous trade that has totally blown up, and many funds have been caught in margin calls and other things like that in recent days, where they were trading the spread between the two, because it is essentially the same asset. And as the price of gas in Europe becomes too expensive relative to the gas price in the United States, you could potentially trade that spread. And that is the price of the spread. So let's say in this position, you would say, all right, I am going to short the natural gas price of Europe and buy the natural gas price of the US, and it reverts back to the mean. You make money. Some people even refer to it as an arbitrage trade. But then again, that wasn't a pure risk-free arbitrage trade, as we've seen by this massive move in European natural gas prices. So it's one of those classic examples where the markets could stay substantially irrational longer than you can say solvent, given the margin call situation. So just wanted to kind of start that off today.
Itai, why has the United States natural gas prices not caught up, or not anywhere close?
Yeah, I mean, there's a different supply and demand dynamic too. I mean, there's not as much, there's more supply in the US of natural gas, and even though it did go up, and there's more, and there's definitely has been more demand, but Europe is more dependent on Russia, for example, and they also have different demand dynamics. So they let's say live in cities where there's more dependency potentially on natural gas for heating and things like that. The winter is approaching there. And it's kind of like the perfect storm of multiple different things really hitting them hard right now with energy prices. So they're actually calling it a full-scale energy crisis at this time.
I mean, one of the things we have here, especially in Texas, is we had when nat gas went up years ago, like I guess 12 per 10,000, is people were drilling like crazy. When it dropped, they just capped the wells. So it takes almost nothing for them just to turn on the wells and just open in the spigot when the price gets right. So we have a very ample supply compared to places like in Europe and other parts on Earth because we have so much natural gas.
It's true. And at this time, also Russia cut the supply going into Europe substantially. There's some geopolitical plays in there because they want to approve a pipeline that will end up going into the European Union. They're playing some games, but won't go too deep into that. The idea here is, it's always good to assess what you even think is a risk-free type of trade, as it caused a lot of pain. And I wouldn't be surprised if we'll see some funds that ended up defaulting as a result of what we've seen in natural gas prices. Okay, so let's talk a little bit about the great inflation of 2021, as that relates partially to it with what we've seen in natural gas. So we got oil as measured by WTI up 61%, net gas still up 120%, even in the US. Food prices are up an average of 33%. Shipping costs up a stunning 225%. Housing prices on average up 19%. Core CPI is 6.8%, and wages are up 4.9%. So of course, there's some base effects into it, given the depression of prices in the pandemic, but nonetheless, it's still some of the highest number people have seen in our lifetime, last 20 or 30 years or so. So let's break it down and see where inflation comes from versus the average. So the vast majority of it is coming now from used car prices, hotels, and things that are related to the pandemic. But at the same time, you're seeing here that some of these have not caught up yet, like housing, that we'll break into in a second. Here is that chart we referred to at the beginning, with Phoenix leading the charge year over year, based on, actually it's B of A and Bloomberg research. And you can see that Phoenix is very close to levels seen in 2005 during the notorious housing bubble, and housing prices are accelerating substantially. Now that is now translating into rents as well. So you can see here this was the pre-pandemic trend. So rents have gone up, but gradually with that seasonality effect going a little bit higher in the summer and dropping a little bit in the winter. And this was the pre-pandemic trend. And now pandemic took rents down a little bit, and now they've exploded far beyond the pre-pandemic trend.
Yeah, you can see it's about a 15% change in us owning a number of, a few hundred multifamily units in a few different markets. This is absolutely in line with what we've been seeing. We've been pushing rents all across the board. So not a surprise for the people that are in the multifamily game.
Right. And also supporting that, it's not just price increases, but you're seeing vacancy rates. Well, now they've ticked up a little bit into September, but you've seen an average vacancy rate of 6 to 7%. Actually, 7 was the top during the beginning of the pandemic, but now just at about 3.9 or 4% is very, very low. And it's definitely a market with a lot of demand right now. So why is this important? Shelter and inflation is a very significant part of CPI. And a lot of other things were leading the inflationary move in CPI previously. And you can see here that apartment list national average price year over year, percentage change, and the CPI rent portion of CPI. So you can see that apartment prices has on average led CPI by 4 months. And now we're getting into the time where you could potentially see a substantial increase in months to come.
So based on what we're seeing here, for the people who aren't seeing the screen, you could potentially see 5-6% increase in overall housing costs that finds its way into CPI over the course of the next few months.
That's exactly right. So you can see that also here in this Goldman tracker. So this takes you a little bit further back, starting here in 2005. So you can see their inflation tracker here also being close to the 5% mark, and the shelter index currently pricing in just half of that, and potentially is going to put a lot more future pressure into CPI, which, as we all know, impacts Fed decisions, markets, and other things.
Got it.
What is the E.K.A, what is the percentage of people that now own a home? Because I know it usually fluctuates between like 62 and 65% of like home ownership. Has that gone up or down during the last year?
Yeah, it's still roughly around those numbers, but one of the problems is the market is pricing out a lot of first home buyers and things like that. So higher prices could translate to lower home ownership going forward, but the numbers haven't fluctuated too wildly there. Okay, now we all famously know Jay Powell was saying inflation is transitory, which it's kind of a big bet that the Fed is making by keeping policies the way they are. And we'll dig further down the call why those things are the case. But inflation is,
Where did you
the
find
Fed transitory.
that picture? Where did you find that absolutely killer picture of the Fed chair?
I Googled J-PAL and looked at images, and when I saw that, I was like, that's got to be there.
Looks like a suit that only money could print.
That's exactly right. So here's what's interesting. When you're looking at probability markets priced by different Fed funds futures and other things like that, and this is actually taken from the Federal Reserve themselves, you can think of the following chart in the following. So the red line represents probability of inflation by being greater than 3% inflation over the next 5 years. And then the blue line represents deflation, which is inflation that's sub 1%. So you can see here in the early part of the pandemic in early 2020, there was a very large spike into that deflation because nobody imagined the amount of money printing that's really going to come. And currently right now, probability is that there's about a 37% chance, which is very high historically, that you're going to see inflation greater than 3% over a 5-year horizon. So that's pretty substantial and not transitory at all, or at least that's what markets are currently telling us. So that's also reflected in other places. So when you're looking at measurements of business inflation expectations, it's the highest it's been over the last 20 years or so. You can see here that decline in early pandemic or 0809 and where we are now. And it's also coming in looking at the inflation index here on Goldman. And also what I find really interesting is mentions of the word inflation on the Russell 3000 earnings calls. So that's going back also about 10 years. And you can see that now it's being substantial, and that correlates fairly well with potential higher inflation, and it's at a relatively high value. So why is that so important? It potentially puts the Fed in a difficult situation that they may have to hit the brakes sooner than they're telegraphing the market. And I think that's one of the reasons the market has been correcting over the last month or so, especially led by big tech. So what you're seeing in this chart is in the black, that is the price of the US 10-year Treasury bond. So when you're thinking about the bond market, when you have the bond price on one side and then you have yields on the other side. So if bond prices rise, yields fall. If bond prices fall, yields rise. They're inversely correlated. So you're seeing that as bond markets have fallen in price, meaning higher yields, the NASDAQ, here measured by the NASDAQ 100, directly fell in a response. So in the recent year, there's been a very tight correlation that has developed between large tech companies as measured by the NASDAQ and that 10-year yield. So it's very interesting to see that.
Itai, historically, was there a correlation between these two? And if so, why did it just pick up now?
Yeah, so I think correlation between equity markets and yields, they come in and out. So sometimes it's more correlated than others. Sometimes it's not correlated at all. Nobody knows the reason for sure, but my educated guess would be that in the last year or so, we've seen equity valuations and equity multiples rise substantially. And we've seen tech companies, and we talked about it in the last call, we've seen tech companies multiples being pretty substantial, and the premium for growth very, very substantial. So it makes sense for them to be more sensitive to interest rates because higher interest rates are typically inversely correlated with valuations.
Got it. 2 other quick questions. What's on the x-axis of this graph?
Yeah, those are just pricing of those two different things. Oh, and as far as time goes, that's roughly a year, or maybe a little bit less.
Okay, got it. And I think the other thing to point out is you talk a lot of times about the 10-year Treasury, and it's very important as a proxy for lending in the housing market. That's what we use whenever we're trying to figure out where we think mortgages are going to go for bigger commercial real estate projects. And also now there's a correlation between this too and what looks like the tech company index, the NASDAQ. So it really would be important for, I think, people here to follow closely what's happening in the 10-year Treasury, given it's tied to a lot of these key indicators.
That's exactly right. It's one of the most important indexes in the world, in my opinion.
TLT.
Or TNX for just yield on the 10-year. TLT would be the 20-year bond ETF, I think. Okay, so let's talk about the general markets here. So here we're looking at the NYSE, New York Stock Exchange, which measures thousands of stocks. So that's a much broader range than just the S&P 500. And just to see that we have, in fact, stayed flat for about 5 months as the market is digesting, the Fed and the big move on the upside and all these things. So typically when the market kind of consolidates, it will pick a direction at some point. And you see this was the QT program where the Fed was actually trying to reduce their balance sheet. The market didn't really like that. And then the Fed pivots to not doing that anymore. COVID crash, then massive money printing coming afterwards, election uncertainty, consolidation, then the vaccine and all the fiscal stimulus that's going on, and now where we are in this summer consolidation. It's interesting to note too that the market is, or what I would say, the wealth effect is very susceptible to a correction here. When you're measuring the amount of US households' equity as a percentage of total financial assets, it's really high. So households hold 50% now of equities as the market ran up, versus let's say 34% that they did in 2009 or 48% that they did in 2000. And potentially, a drawdown from a place like this could cause problems for the wealth effect, meaning, you're feeling like you have more money because your stock accounts go up, and then as a result, you go and spend more. And because 70% of the economy is consumption, so on and so forth, you have the virtuous cycle. So that's a thing to consider with incentives of why the Fed may want to keep this going. Okay, so we talked about all this inflation and all these things happening, but there's actually something very, very strange with this period of inflation versus other historical periods, and that's that the dollar is actually up. So generally speaking, periods where you saw a lot of big moves in commodities on the upside, the dollar was down because the dollar tends to be inversely correlated with commodities because commodities are priced in dollars, right? So it actually is kind of strange where you're seeing a year where the dollar index actually is up and up even quite a bit, 7% this year, and commodities are up this much. So it just means that the demand for the commodities is much greater than just the what would be a decline in the dollar in other years, right? So in this case, it has to surpass the increase in the dollar, and in order to get to that point. So we're only seeing 2000 is another year where the dollar was up and commodities were up anywhere close to this as well, which is kind of interesting.
A.K.A, is that because of that our economy sucks less than everybody else's?
It's part of it. More money going into the U.S. from other places because there are dollars coming from other places as well. But there's supply shortages, other things in other places. It's definitely a part of it. I think it's a little bit more complicated than that. We'll touch base about it in a second. This is kind of interesting too to see this chart. We're starting here in 2000. You can see which one of the big asset classes performed the best and the worst on any given year. So here's that 2021 commodities up 57%, S&P up 21%, gold down 13%. For example, the total opposite of last year where gold was up 25%. But in recent years, we have seen S&P being in the top part of the chart for a while. Just interesting to see the differences and the importance of diversification.
Yeah, this really underscores how you have enough uncorrelated type of assets under one bucket, the better it is, right? You you basically just have different assets each year that are performing and others that are not so much.
That's exactly right. Even though I wouldn't necessarily count this as diversification, but this is what they would tend to say, the big asset classes. All right, so here's something to consider that I think is important. When you're thinking about rising inflation on one hand, but then you get rising dollar on the other hand, can that actually translate into stagflation? And I think it's important to understand then for a second. I know we talked about this in the past, the position of the dollar in the world. So what you're seeing here is where dollars are being used in the world today. And I think the most important part is the international loan market, where about 60% of loans are still in US dollars, and foreign reserves, which is an even higher percentage of that, still being held in dollars. So why is that important? Let's talk about the dollar cycle here for a second. The dollar cycle basically just means dollar, rises and falls over time as a result of monetary and fiscal policy and all the things that are happening around the world. So you would expect, or have expected, that given a massive amount of Fed intervention, money printing, QE policies, and all these things that are happening, the dollar would actually fall way more than it is now, but that's just hasn't necessarily happened. There was an initial drop of the dollar in 2020, but the dollar has been getting stronger. So governments and companies actually outside of the US, they hold a lot of dollar debt, 13 trillion actually, based on data I found from the BIS, and they even have more assets in dollars. So that's around 42 trillion. And they've been built over decades and through trades with emerging markets and other things like that. So let's talk for a second about the dollar, that dollar cycle measured by petrodollars. So petrodollars just means that for whatever reasons, there's actually a deal struck between the US and Saudi Arabia in 1971 to trade dollars for gold. And that's been the go-to system since, as a way to kind of replace the Bretton Woods system. If anybody's interested more about that, we've done a very long three-hour series about the petrodollar and how that actually works. So it's actually fascinating, and I'd recommend checking it out at some point. But generally speaking, the way that works is countries need dollars to buy oil. That's just the way the system works because oil is priced in dollars. And after doing that for decades, it's been going since the 1970s, right? There's so much international financing that's happening in dollars that countries need dollars in order to serve those dollar debts. So if I was even Norway and I wanted to build an offshore rig for oil, I'm going to borrow that money in dollars, even though I'm not even dealing with the US at all. So now you have a situation where the dollar is not just backed by oil itself, but it's also backed by dollar debts. And that's a very, very strong self-reinforcing effect because it just keeps going and it creates inertia to keep going for a very long time. And what's interesting is at this point, a lot of those debts are not even owed to the US. They're actually owed to other countries, between other countries, and everybody's just dealing with dollars.
Iqui, can you explain why some of these countries might want to do a loan in dollars versus maybe their home currency?
Yeah, so if that debt system is happening in dollars, if they lend some money in dollars, they also have other debts in dollars. So they need dollars to pay those debts. They may also need dollars to buy some commodities because most commodities will be priced in dollars. And that's just the way the system has been structured.
Got it.
So I think we have to understand then the way strong dollar works for the global economy to get the context for that next piece. And so Jeremy, do you remember from our petrodollar call, what happens to emerging markets and profits during a strong dollar period?
Yeah, they get crushed.
Why?
Well, so when you have a strong dollar situation, imagine you're one of these emerging markets. It now requires more of your own currency to be able to buy dollars, right? So that in effect means that you're having to give more of your own currency for dollars. That's almost in effect quantitative tightening right there.
But why would you need then more dollars?
Why would the emerging need more dollars?
Correct.
Well, they need more of their own currency to be able to buy the same amount of dollars, correct?
Right, but because they borrowed their money in dollars, then basically they have a bigger debt to serve because then their currency is worth less than those dollars. And then that creates a very problematic situation for their economy. So basically, therefore, a weaker dollar period is almost like quantitative easing for the rest of the world. And that creates a really weird situation that we're seeing right now, because on one hand, we're seeing raging inflation prices everywhere. But on the other hand, it's almost looking like we're going through a stronger dollar period, which the world wants more QE while that's happening. So this is a chart that shows you what happens during a strong dollar period to corporate profits. So the dollar index is here in blue, and then you got corporate profits here in green. And you can see the dollar goes up. Basically, there's a flattening of corporate profits or even a decline. And we've seen that as early just before 2020. This chart needs a little bit updating. So corporate profits have gone up post COVID. Dollar's gone down a little bit, but then has turned back up. So again, think about it in that context of what do you do if you're the Fed? Because a stronger dollar is not necessarily good for the economy, profits, and things like that. Could be actually very deflationary. And at the same time, we're seeing really big inflation numbers happening. And the Fed is really caught between those two. I think not really realizing what it is that they need to do, given that the risks are really high on both sides at this time, which is why you have some stagflationary forces, which technically, based on classic economic theory, none of this should happen at the same time, but it is. All right, so let's talk real quick about the debt cycle and how this relates to all those things. We covered it in the last call, so I'm going to cover it very briefly. And if you have any questions, you can either ask or watch the last video. But let's talk about the short-term business cycle and how that even works. So let's say at the beginning of an economic expansion, customers and businesses, they start recovering from the previous recession. So they take on more debt and more risk. Let's say Jeremy calls me up and says, look, this building fell by 40%, and I really think we should take some debt and buy it because it's much cheaper now and we should do it. So we're willing to go on and we're taking debt, we're taking risk in order to do it. So as the expansion progresses, you're just tacking on more and more debt. And eventually you're investing too much because now the prices of our buildings have gone up. So we refinance them, we're taking more debt, and we're overpaying for something that we shouldn't because the numbers start not making sense at some point. And everybody does that. So as the economy expands, that's just human nature. So asset prices during this time, they go up. So eventually you get to a point that you get a negative catalyst. That could be COVID. That could be 2008. That could be a lot of different things. And when that happens, if there is too much debt in the economy, only if there's too much debt in the economy, it creates an economic shock and forces people to pay their debts and deleverage. So policymakers, what they do, they typically would lower interest rates while that's happening in order to allow you to get through that period. And typically what people do, instead of paying off the debts because lower interest rates are available, they typically refinance those debts at a lower rate, and they kick the can down the road. And that's kind of how that looks like. This is the growth period, and then you have that expansion, and then you have the trough, and then you have that's what creates the business cycle. So if you didn't have debt in the system, none of this would actually exist.
It's all that. And that last time we had that deleveraging, that would have been during COVID when we're having those market limit downs, where all of a sudden the people are getting their margin calls, and then all of a sudden they are force triggering having to sell assets to cover the debts, pushing prices lower, lower, lower. And now we just inflated the bubble even bigger. So, who knows how this will play out, right?
But that's just human nature, right? Because think about the policymakers' response to a recession. When you get that recession, you almost never reduce debt too much because you don't want to go through the pain. You get the lower interest rates, you refinance the debt away. So businesses will probably reduce some debt, but they're always going to start the next cycle with more debt than they had before. And monetary policy wants the next business cycle to start as soon as possible. So they just inject money to make that happen. So this is how that looks or has looked since the 1980s in here. So in red, you see the interest rate environment or the federal funds rate. And then here in blue, that's corporate debt, which is private, owned by businesses and corporations. So every time you get a reduction in a recession, you see the grays are recession. Every time you get a recession, you get a reduction in that private debt and interest rates drop, and then it reinflates again. But here's what's interesting. Every time you're getting lower and lower and lower rates, up until the point they get to the zero bound. And the zero, they can't really go lower. They can go marginally lower, like negative rates in Europe and Japan, but it's not substantially making any difference. And then the debt goes higher and higher and higher.
So if you were sitting in power, if you had to predict the future, and we had one of these negative economic shocks that caused a major downturn in the market or a recession, do you think that they would take interest rates negative in the United States?
I think they could try it. It just hasn't really worked in places that have tried it, it didn't really cause growth. I think the difference between 0 and -0.5% is not substantial. So I don't think they can take it over that on the negative side, because that's going to create very weird phenomena. But I don't necessarily think that those experiences have worked for Europe or Japan, not in the way they wanted them to.
Yeah.
A.K.A, you mentioned about the previous chart talking about recession. I mean, where do we sit in regards to recession now?
So we're out of recession based on the classic definition. We're back in expansion. That was the shortest, I think that was the shortest recession in history with COVID so far. But let's talk about this. So there's two kinds of debt, right? We just talked about that private debt or corporate debt. You can see it here. That blue is private debt. But there's another type of debt, which is federal debt. So federal debt, unlike private debt, actually moves countercyclically. So what that means is that when the economy goes into recession, people lose jobs, things get worse. And what does the government have to do? The government has to spend, because all these people that lost their jobs, they're going to need to get unemployment benefits. Sometimes there's social programs. In the case of COVID, you had checks going to your houses, massive unemployment benefits, and all these things. So the government has to spend way more during the time where the private sector actually reduces their debt holding. So at some way or another, debt is always increasing. Debt is never truly declining, because even if private debt is declining, federal debt is increasing. So you can see that here, where the business debt is falling, but federal debt increases, falling, increases, and now actually both are increasing at the same time, as all the old rules are kind of moved away. But at some point, the debt continues to grow. So then you get to a really interesting point. After many of these short-term business cycles, so business cycle happens, recession, Fed lowers interest rates, then it happens again and again. But at some point, you get to that zero bound, which we're in today, and then it's just very, very difficult, because you can't take interest rates any lower. And then you start doing crazy things like QE and other things like that. And even when you do that, there's just so much debt that it just hinders future economic growth, and it's very hard to get rid of it. So that only happened twice over that last 100-year period. Happened in the 1930s and happened again in 2008 and during COVID, really. So you can see how that's kind of one of the same. So what you're seeing here is the total debt to GDP. So now you're seeing not just that federal debt, but you're also seeing private debt. So it's both of them together, just the total amount of debt in the economy. And you're seeing the interest rate environment, or short-term interest rates. So you get the zero bound in 1930, and that stays for a while. And then you get the zero bound in 2008, and we're right back into that zero bound. So we've seen it now twice in modern history.
So what happens then, Itai, if there's just a massive run-up in inflation and it's sustained, and the Fed has no other choice but to raise interest rates? What does that mean?
That's why we're in a. That's why it leads to. That's kind of why I had that discussion at the earlier part of the call, because I think this is one of the most unique periods of time, because the risks to the economy, given the debt load, is substantial, right? I don't necessarily think the economy can do that, but they do have a way to resolve it, and that's through money printing. So here's how that worked in the past, right? There's a way to look at debt as a percentage of GDP, which is the way we just did. But you can also look at debt as a percentage of M2. M2 is the money supply, or the amount of money in circulation. So what happened in 1930 is that there was, in the 1930s, I think it was in 1933, all privately held gold was taken away from US citizens by presidential decree. And they devalued the gold peg, and then they printed a lot of money. And what that did is they reduced the total amount of debt as a percentage of the money supply. And guess what happened again in 2008? QE period started, a lot of money was printed, and as a percentage of the M2 money supply, the debt has declined as well, even though the zero bound is in there. And why does that happen? It happens because the normal business cycles simply can't happen. So in a normal cycle, what happens is people pay for that overinvestment by just losing money, filing for bankruptcy. It's what's called the capitalism creative destruction. A business will merge and eat the smaller business that failed and things like that. But when you have an enormous amount of system-wide debt, which is hundreds of percentage of GDP, which we are in that situation right now, including sovereign debt and all these other kinds of things, you just can't deleverage because it would just crash the entire system in a way that would make us all live through a depression. And why does that happen?
Yeah, that's what I want to know.
Why does that happen? It happens because, let's say I owe you money, right? I have a liability. The money that I owe you, Jeremy, is your asset, right? I owe you $100. That is my liability and your asset. But if I default on that liability and I say, forget about it, I'm not paying you that $100, that asset is destroyed. You have an asset that you thought you had, and then you wake up one day and you realize you don't have that asset. So if most assets in the economy are bought on debt, are bought on leverage, what does that do? Everybody wakes up and realizes that all these assets that are in the system are worth nothing and they don't exist. So then housing prices collapse, stock markets collapse. All these things that were built on totally collapse because there's too much leverage and debt in the system. So businesses will then start firing people and cutting all the expenses, which is even more deflationary because 70% of the economy is consumption. And as a result, people just don't buy because they just lost their jobs. And then it creates even more losses and even more businesses are caused to fire. So then guess what? The tax revenue for the state collapses because people lost their jobs and they don't pay taxes anymore. And then even the sovereign bonds that countries are run on that basically can default because then nations themselves could find themselves in a situation where they can't pay the debt. And that's because we just have too much debt in the system. And that is a full-on depression. So knowing this, they can't afford to let that happen.
Sure, but on the flip side, you have, if inflation runs so hot for so long, then you're what? Like, at what point are you in like a Weimar Germany where you're literally risking the entire collapse of the financial system if you don't hike those interest rates? Like, that's what I need. That's where I need to kind of understand at what point is inflation so hot that you have to do something about it.
Which is one of the reasons the Fed is in such a tough place, because on one hand, you are running inflationary risks and they are saying inflation is transitory and downplaying it for this exact reason, because this, what I'm showing you right there in this slide, is so much of a risk that in their calculation, this is a much greater risk than running inflation a little bit too hot. So printing is really the only option that you have in this type of system, which is fiat, because they have no incentive at all to let this deleveraging happen naturally. When there's just too much debt, nobody wants to go through a depression, right? And when you're in that zero bound, there's no more buyers for bonds because they pay nothing. So they do QE and basically buy the bonds themselves. So it's interesting where those peaks in private debt, they're deflationary, and in private debt, in public debt, I'm sorry, they're inflationary. I'll talk about that in a second. So you get this double peak scenario. It happened in the 1930s. So here in 1929, 1932, they devalue the dollar versus the gold. They run the deficit. By the way, the orange here is the non-federal debt to GDP. And then that actually drops as there's more money in circulation, because this is, again, the debt as a percentage of GDP. And then World War II happens and federal debt massively increased as a result of World War II. And then you run deficits and treasury yields are below the inflationary rate. Very similar things happening this year, where in 2008, they start with recapitalizing the banks, QE, et cetera. And right now, massive deficits are being run. And also, you can make the argument that treasury yields are far below inflation. So what's happened in the 30s is that the federal debt as a percentage of GDP actually shrank quite a bit, but in dollar terms, it only decreased 20%. What did happen is that the US dollar fell from $35 an ounce as pegged by gold to $20 an ounce, which resulted in massive expansion of the money supply. So this depression, World War II period to 2008 COVID is somewhat similar, where in both places they've used massive QE programs to fund the deficit spending. Treasury yields were below the inflationary rate, and economic inequality exploded during this time because a lot of these benefits went to the 1%. You can see that here. Basically, the wealth owned by the top 0.1% as a percentage of the total wealth versus the entire bottom 90%. So right now, the top 0.1% almost has as much as the bottom 90% right now, which is very similar to the 1920s and 30s. So here is the coronavirus deficit. You can see that it's substantially greater than the Great Recession. It actually is the most amount of deficit since World War II. And you can see that the total national debt, federal debt, is expected to exceed the peak post World War II. So more debt than World War II. So again, I said in the beginning of the call, unprecedented time. That's exactly what I meant. So what's interesting here is that money to the system, as far as this expansion, is not necessarily the same as money in the system. So what I mean by that is when there's too much debt, growth is still slow. And as a result, the velocity of money declines. So what's the velocity of money is how many times money circulates in the economy. So I go to a restaurant, I spend $100, and the server takes that $100 and then they spend that, and then they go to somebody else and they spend that. So how many times that $100 circulates in the economy is velocity. High economic activity, high velocity. So just having more money in the system doesn't necessarily translate to more velocity. So the 30s and...
You want me to take a quick pause maybe and get a few questions?
Oh yeah, absolutely.
Let's see, I know everybody, we've been going fast. Is there anything that's on your mind as you're seeing some of this stuff? All right, Itai, maybe you were on a roll. Keep going with it.
All right, sounds good. And I'll make some time for questions at the end because we don't have too much time and I wanted to make sure we cover some of these. So basically you're seeing that happening in the 30s and in 2008. And it's actually one of the main reasons that they're so different than other recessions, because that's just too much debt, and as a result, velocity is just slow. And central banks, they can't force the banks to lend. So the broad money supply just doesn't grow as much as the monetary base. So what I mean by that is here you can see the monetary base as a percentage of GDP in blue going back to 1920. And here's that money multiplier, which is velocity, right? So you can see that during the 30s and 40s, it's very low because economic activity is not that great. And now in the last 10, 15 years, we're seeing that the velocity of money is low as well, even though the total amount of monetary base exploded. And the reason is you can give money to the banks, but you can't force them to lend. So what you're seeing here is the total amount of loans and deposits in the big four banks. So JP Morgan, Bank of America, Citi, and Wells Fargo. So in 1999 through 2008, they are basically lending what they're getting. And now they have so much money, $7 trillion of deposits, but they only have $3.5 trillion of loans. There's literally 2 times more deposits than there are loans. And all that money is money that's not in the system. So the fiscal policy is what leads to inflation. Let's talk about that. So what you can see here is a very interesting chart where you can see the total debt to the M2 money supply in blue, right? And you're seeing the federal deficit as a percentage of GDP, and you're seeing inflation in orange. So what we saw in 1930 is initially there was a non-inflationary devaluation because they created the QE. But then the 1940s, because of World War II, it was very inflationary. And then what we've seen in 08 was the same. The first QE wasn't true inflation like street inflation. It actually caused asset price inflation. But now in 2020, we could see something similar to what World War II was because money was going into the actual economy through fiscal stimulus. So let's talk about what QE really is. So when you only get QE and you don't get fiscal, it's almost like a bank bailout. So before 08, banks were super leveraged. They had less than 3% in cash for assets as assets and a little bit of treasuries. And they just lent out everything that they could, and they were super, super leveraged. So they can't just raise cash by selling assets because the market would collapse. So what the Fed does, they come out and create money out of thin air, and they give the banks that money in exchange for some of those mortgage-backed securities and treasuries. And in 08, 09, those mortgage-backed securities were not worth much. And the Fed was basically buying it at full price. And as a result, the banks were recapitalized. So it's not inflation because it just goes into the bank balance sheet and it's not widely circulated. So you see that right here. These are assets on the bank's balance sheet going back into the about 1980s. So this is the treasury holdings that they have in red, and then this is the cash that they have. So see, look, going year into 08, banks just have less and less and less cash as they get more and more leverage. And 08 happens when they're sitting on the lowest amount of treasuries and the lowest amount of cash. So then QE1 happens and boom, money goes back into the bank balance sheet. Then QE2, then QE3. Then the banks just start losing that cash again. And then the repo happens and banks get money again. And the Fed just wants to keep banks above this level so they're not too risky. So when you get QE plus fiscal policy, that's the real money printing. So in 2020, banks already had plenty of reserve. They don't really need QE, but the economy needs QE because there's no money in the economy. Everything is shut down. People are not getting wages and things are really problematic. So new money is created out of thin air, but it's not enough to give it in form of QE because then the banks are just going to get it and it's going to be the same thing as before. And how does that relate to necessarily the money supply, right? 2020 had a huge increase in the money supply because QE was used to finance all these deficits. But in 2008 through 2014, the first period of QE, that QE didn't translate into inflation and didn't really translate into the money supply. So when you're looking at M2, M2 includes mainly the bank deposits, which belong to the public, but because it stayed on bank balance sheet, it didn't get there. So the money supply itself didn't really grow as much, which is why QE at first was not inflationary. So here you can really see that in this chart. So you're seeing the total amount of deposits in blue as a rate of change, right? And you're seeing the assets and the government transfer payments, basically how much money the government itself is sending to people. So this could be these unemployment benefits, this could be the stimulus checks and all these kind of things. So here is 08 and here is the QE, the first periods of QE. And guess what? QE happens, stays in the banking system. Government doesn't send too much money. Total amount of deposits doesn't really grow too much. But look how different 2020 is. You're getting all three shooting up together as the Fed is directly giving the money to the government's directly spilling it into the economy. And that's also why you're seeing that M2 money stock in 08 and post the first QE, it grows very slightly. And sure, we have that gradual growth, but none of it is like what we're seeing in 2020, where literally all of that ends up into the real economy. And that's the real reason you're seeing these inflationary numbers continue to expand as you're getting QE and fiscal policy together. And that's really how I think QE works and why that first stage of QE didn't really translate into inflation and why 2020 is so different. So anyway, I know I said a ton and I combined a lot of different topics to kind of give you that point. So I'll stop right there and see if you have any questions, as we did it exactly in time.
You really spilled out a lot pretty fast, man. That was impressive.
Appreciate that.
Got it. Well, what's the biggest concern? Like, what's the biggest concern that you have for the economy when you're just looking at all the different factors happening right now?
Yeah, I mean, I think that this is a really tricky situation because I think the risk of deflation is still higher, given the consequences of having such a huge amount of debt and sitting on that low zero bound, which we know really can't be lowered. So I think that they are willing to risk a significant amount of inflation to avoid that. And they're making a bet that inflation is transitory, that could not be the right bet. So I think it's one of the more fragile, risky times that we have seen in the global economy in a while, because the risks on both sides, either we get a runaway amount of inflation if mishandled correctly, or gets into kind of a really substantial deflationary period if the brakes are being put on too hard. That's really substantial.
Itai, one of the questions that came through: why is a 10-year treasury being tied to big tech when most of them have massive balance sheets and have never been healthier?
Yeah, so I think it's just a matter of valuations. And it's not just, it's measured as in the NASDAQ itself. So valuations generally are very high on a relative basis compared to what they were. And valuations tend to be inversely correlated with interest rates. So imagine if you had a 4% treasury, you would be able to park the money there relatively safely. So that's one part of it. And you don't necessarily need to chase growth. And then it's also how much you pay for that extra unit of growth. So if you can't make money anywhere else and the price of money is really, really low, then you're going to chase growth at much higher prices. But if there are more options available and the price of money is more expensive, then it doesn't necessarily make sense to put such a high premium on growth.
Cool. What other questions are on people's minds? Where do we go from here, Itai?
It's a good question. It's a good question. Remains to be seen. I think that the current policy is probably going to continue. It really depends on how this inflationary thing ends up.
I think the thing you keep pointing out, and I've seen we've been having these calls for over a year now, or a year and a half, is that obviously a lot of things take longer than anybody could predict. And it's kind of like a steamboat going down the river. It's hard to turn around and stop until it sinks. So it's hard, it's almost anybody's guess, but you can set yourself up for whatever the scenarios that could be coming down the road. You just can't time it.
That brings us to that first quote that I started the call with, right?
So I want to know the Fed chair stock portfolio method that you were talking about earlier.
That would be.
We'll dig in on that shortly. I will stop the recording for now so we can actually cover it, and then we'll let other people hang on if they want to.